Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner.
Hello, everybody. Welcome back to Real Estate Milestones. Today we have Jake Clopton, who is a serial entrepreneur, author, and economist. He has a focus in real estate and finance across various aspects of commercial lending, insurance products, property ownership, and management. And he's a regular contributor to both print and broadcast media. So, Jake, thanks for coming on the show today.
Absolutely. Thanks for having me on.
Sweet. So let's start with the first question I always ask on the show. What's your first milestone in real estate?
The first thing I did that was real estate related was, I guess, a little more ambiguous. So I was trying to start the company that I currently run now, Clopton Capital, and that was during the Great Recession, which was a credit crisis, right? And the way that I built that up was just by cold calling anybody and everybody that I could find that would be potentially lending money. So banks and private lenders and everything, right? And just eventually finding guys that were lending. And then at the time, like if you had somebody that was even lending, people just kind of come to you. So that was really my first milestone, was just doing a ungodly amount of cold calls to capital sources, trying to build up, a network of liquidity during that time.
That's pretty awesome. I guess who was the first to lend? I guess what kind of companies were the first to?
Oh God. I can't remember who the first person was that I find. But honestly, a lot of times, like small banks, like local regional banks, during even tough times, like they can be kind of insulated to that type of stuff. So they typically have pretty conservative portfolios, and they'll keep lending. So that was one of the areas where we found a lot of value, right? I mean, if you had a property, the guy that was literally like a commercial loan officer that worked down the street from the property was usually a pretty good place to start.
Yeah, I've heard that before, especially given that they have a unique insight into their market. They know where to be bullish. They can get granular with it. It's like, well, we actually really love this street versus like what's Wells Fargo going to do? Like, where it's like, oh, we don't like New Orleans at all. Like,
Right.
Yeah, so that's pretty cool. Okay, and so I want to take a step back before we get to your first real estate milestone. You started in, if I remember correctly, interbank hedging product futures. Is that correct?
Yeah. So that's how I ended up in Chicago. So I moved here to trade futures. Chicago is a trading capital world. At least future trading capital world. I don't know if it is anymore. Because everything's electronic now, right? But I worked at a prop firm, and all we did was trade 3-month LIBOR and Fed funds and Treasury futures. And that's kind of where my banking background, I guess, kind of came from. But I have a little bit of a different perspective than most people that are in the industry, because you don't get a lot of like ex-interest rate trader guys, doing capital markets for real estate. It gives me a good kind of different perspective into kind of like where interest rates are going, and markets, and how like large banks work and stuff like that. Also I'm doing that up until 2009. And then that whole thing just dried up and went away. I think one day literally the market disappeared. You see like a bid and ask usually, and they're just gone. So that was kind of the evidence to start looking towards something else to do, and how we ended up, how I ended up anyways doing what I do today.
Awesome. Well, that's pretty cool. And definitely want to get some of your perspective on situation as it is now, given you have a little bit of experience seeing it on the pricing side. I know that gets pretty complex there. But
Sure.
Before we go to there, I'm kind of curious, just in terms of your business now, just describe Clopton Capital. I guess describe all you're very entrepreneurial guy, and you got a lot of different verticals. So I want to, let's talk about, I want to get exposed to the full breadth of it before we go down some of the holes.
Yeah, the way that I started looking at our company was more like a full outsourced like finance department, right? So what I did was start piecing together like different verticals of ways that we could offer value to our clients, and all those clients are owners and operators of commercial real estate. With that in mind, I run all of our capital market stuff and have since I started doing this. But I also started, and we're now a nationwide commercial property insurance company as well. So all we do is commercial real estate insurance. And then we also do financial modeling and outsourced CFO work and investor reporting. Um, Again, I have a couple other guys that run that stuff. But it's all stuff that commercial real estate people can use, right? And all of it is like outsourced services in some way, even the capital market side, right? Because if you go to a big enough firm, like a BlackRock or something, right, that owns a ton of real estate, they're going to have like insurance guys in house, or capital markets guy in house, financial modelers in house, right? And we're really a good fit for like small to middle market companies that want to offload that time constraint of doing all the stuff themselves and focus on acquiring deals. So that was kind of the thought process behind it, and I think people are appreciating it. So it's working out pretty well.
Awesome. So let's start with the finance debt side of the business. What kind of loan products are attractive now, given the current situation with the, I guess there's a little less liquidity than last year. Interest rates are higher. What products are working for people that maybe previously had more access to capital? What's the new creative solution to get deals done that you know people may have not previously looked at?
Yeah, it depends what the deal is, right? But I think as an overall macro theme, private lenders have really stepped into the vacuum of where a lot of depository lending was going, or has disappeared from, right? So as banks pull back further and get more conservative and pull back on leverage, stuff like that, the private capital markets, right? So debt funds or other private lenders, balance sheet, perm lenders, stuff like that, have really kind of stepped into that vacuum. And I don't know where you'd find the chart, but I'm sure if you could find it, see a graph of like, deal origination volume from private lending, it's just gone up and up and up the past few years, but I'm guessing this year you'll probably see it explode. So I would say that's, the biggest macro theme. A lot of the stuff today, that I see is, you know, people a little hesitant to lock in long-term interest rates for perm stabilized deals, right? Um, but then also a lot of short-term lending, which works well for the private space, a lot of bridge lending and construction. And then the other products that are of really high demand are gap fillers in the equity space. Because you're seeing a lot of deals that are maturing now. That now that rates are a lot higher, they're having trouble being refinanced in the perm markets. At levels where they were underwritten to like 2 years ago, right? So we're seeing a lot of mezz and pref equity and stuff like that in demand. So I think what people are kind of anticipating is that we'll pay down debt a little bit with some gap filler equity, and then that'll come due in 3 to 5 years, and by that time underlying rent economics will appreciate to the point where you can just refinance that stuff out with normal debt instead of prep or mezz.
Perfect. Yeah, that's really interesting. So let's get a little more granular on that point. What if you have a specific example of a recent deal with Pref or Mez? Can you kind of walk us through that and how it worked? And I guess what are the drawbacks of Mez, but then also what are the situations in which it's by far the best solution where you don't really have many other options? To kind of want to hear kind of the thought process between how you decide on going this route and then how a deal would look.
Yeah, I think a good example of that today, probably one of the biggest spots in the market where this is a real need, is a lot of multifamily bridge debt that was originated in like 2019, 2020, or even 21, really, when rates were a lot lower and people hadn't seen that lift off in rates yet. And a lot of those deals, right, went off at 85% of cost, and they were underwritten at exit rate assumptions at like 4% with not a lot of cap rate expansion in there, right? And so when those deals come due today, they're really stuck, right? So the difference between underwriting something with very thin margins at a 4% exit rate and now having to stomach a 6 or something higher, right? It's just a math problem, and it just equates to lower debt. And so there's really only a couple options. And one, you can give the property away, right? Which nobody wants to do. Two, you go back to your investors. A lot of these are syndicated deals. Go back to your investors and do a capital call and, dilute the property down and pay off some of the debt with equity. That's an option. Or three, find something that's a higher cap stack, like debt type product, like mezz or pref equity. And I think that's probably one of your better options because that still preserves a lot of like the equity upside but fills that gap, right? So it doesn't give away the upside, in the appreciation of the property, but you're still paying down debt. The downside is that it's expensive, right? So mezz and pref equity are pretty expensive today. Well, they're always kind of expensive in relation to what senior is, but now that senior debt, like prime is at 8%, and lots of loans we see today are at 5s and 6s, maybe even higher. So, mezz and pref, we're seeing double digit, rates of return, if not higher, maybe mid-teens, something like that for some of this stuff. So, that's the issue, right? So I think, really what ends up happening is, during these investments that, let's say you have some syndicator and they raised a bunch of LP equity to do some multifamily deal. They probably need to give away all their cash flow. And then, have their, investors realize the return when they sell the property. Like that's the downside. But the upside is keeping, the appreciation versus diluting the equity.
Right. That makes a lot of sense. And I guess the way I know mezz and pref can refer to a wide variety of different structures. It gets a little more flexible than traditional perm financing in terms of, what can be negotiated and how the actual capital stack will look. But part of me thinks that if you're in this crunch of a situation and rent growth is not as rapid as maybe it was previously, that with mezz debt, you might have to be paying or with pref, you'd have to be paying a preferred return on interest rate higher than your debt service or higher than your cash flow. I'm wondering, do people ever go negative on?
Well, a lot of times in year one, it is a negative cash flow scenario, but the pref equity either have like an accrual feature or like an interest reserve built in to get through that.
Yeah. Okay, that makes sense. Cool. And so guess we're near the end of April in 2023. I guess what are you expecting the Fed to do, and what do you think they should do in the next however many months you're thinking about this? I know no one has a crystal ball, but
it's data dependent, right? I think word on the street is another quarter point hike, and then they'll telegraph that it's a pause. But it depends. It's data dependent, and the thing about interest rates, and because of my background, people ask me all the time, like, "Hey, where do I think rates are going?" And I can always tell them with 100% certainty where they're going. They're either going to be higher, lower, or the same, because there's really no way to predict where they're going to be 2 years from now. You can take a look at the slope of the curve and see what the market's predicting and stuff like that. But the thing about interest rates, right, is that they're global products, and something could happen on the other side of the world, like Ukraine and Russia, and that would totally affect them, right? So it's really hard to predict like where they're going. I think the best indicator you have today is the slope of the yield curve, right? It's totally inverted, and that right there is telling you with all of the information you can gather today, that the best guess is that rates will be lower in the future. You know what I mean? But can you say that with absolute certainty? No, because something may happen tomorrow that could totally change everything. So, I think, when somebody's, really making a decision about what to do today, it's the way that I like to explain it best is it's almost like asking somebody like, hey, what's the best stock portfolio? Okay, the good question, but it totally depends on you when, your investment value and what you want to do, right? Because everybody's scenario is a little different. So, if is locking a long-term rate the best idea today for some guy? It's hard to tell unless you know what the property is, what their plan for the property, and all this stuff, right? So, based on everything's happening today, yes, rates will be lower in the future, but something may happen 2 weeks from now that could totally change that. So it's hard to know.
Right. So it's yeah, obviously it's hard to predict where interest rates will go on a very accurate time basis. But how would one make money predicting the Fed? I guess how does a interest rate futures trader make money given that it's so hard to predict? Would you try to just react faster than the market, or I guess how would someone?
I mean, I
try
think
to
the
make
best
money?
indicator is the plot map, right, that the Fed publishes. And they're telegraphing pretty, you know, I guess pretty clearly that even the Fed governors see the funds rate coming down over the next couple of years. And that's you can see that clearly in the slope of the yield curve that's out there. But again, data dependent, right? If inflation blasts off for some reason, which hey, I mean it could, right? You never know. Then they may stay higher for longer. So I would say like if somebody's out there trying to predict exactly what's going to happen, that's going to be really tough. But you could take a look at the dot plot map or whatever it is from the Fed governors, and then take a look at the yield curve. And I think the best value you're getting today is as far as if somebody wanted to try to game the rate curve and mitigate their risk as best as possible today, and but also get some flexibility, is probably do like a 5 or 7 year fix with like little to no prepayment penalty attached to it, or at least a prepay that's flexible somewhere around that 4 or 5 year mark, because then you can you're mitigating your interest rate risk to the upside while giving yourself flexibility to recapitalize it if rates do come down in the short term. So.
Yeah, that makes a lot of sense because I mean the whole debate between fixed and floating is that if you get a fixed rate, yeah, it's great because you lock in your rate and you don't have to worry about. I mean, the only way you worry about debt service is if your rent somehow drops precipitously. But at the same time, the prepayment penalties take away your flexibility. And as like a finance person or a person who studied finance, options is the name of the game in a lot of scenarios. Like options has a actual financial value, right? And so like the flexibility is something is valuable. So I guess I mean, is there a way around this two-part, just a false dichotomy where, I mean, there's obviously an element of prepay that's mitigated with floating rate, but I guess is there any, cool solutions that you have for getting around this two-part dichotomy?
Yeah, well, there are certain lenders out there that, offer no prepayment, even on 5 and 7 year fixed products. So, there are ways to find, the right deals. I mean, every lender has its drawback a little bit. Most of those types of deals are full recourse, but yeah, I mean, there are lenders with a lot more flexibility. Maybe you can, and some of them will let you buy down the prepayment penalties and stuff like that.
Yeah, I know. I remember learning about defeasance, and it's like you can replace it with a bond that's paying a you place your debt with a
that
bond.
would be like CMBS product, which would be probably not the most advisable thing to get into a 10-year CMBS deal right now.
Right. Yeah, it makes a lot of sense.
If you're thinking about taking advantage of recapitalizing when rates are lower anytime soon.
Yeah, cool. So I guess how buying bonds, would you advise someone to buy bonds with rates high like this? I guess how would you think about opportunity costs and investment situations in a rate environment like this?
I don't know. Depends what the bonds are. I don't know. There's too much uncertainty out there right now or really say much about that, right? I don't know. I don't. There's probably another shoe to drop somewhere in this banking thing, right? Somewhere, and the longer that rates stay high, the longer this stuff goes on for, the greater chances that there's something out there. I mean, we haven't even really. I mean, Bed Bath & Beyond filed bankruptcy today, but we haven't really seen a lot of pain yet. I mean, to be honest, right? I mean, you just haven't. I mean, there's still record employment. So I don't know, man. I mean, I think the next shoe to drop is something, and then credit spreads may widen versus just rates going up, which would affect bond prices and all this stuff. But until you get a little clarity around that, I mean, the Fed usually raises rates until they break something, and I mean, like yeah, we had some banks go out, but I mean, that was over really fast, right? There hasn't really been a whole big thing yet. And maybe there won't be, but there's the potential for something is out there, right? And until that kind of happens, or you really get a lot more clarity that you're on the other side of this hill, I would be hesitant to really, with conviction, say to buy anything in the credit world.
Cool. Well, yeah, that's helpful. And yeah, that's the next thing I wanted to talk about was in terms of where is what there might be another shoe to drop. What signs or flags are you looking for in terms of helping to make advisable decisions for your clients and about kind of having some sort of idea of where we're going? Is what are you looking for? And then like what are some of the risks that you've identified just in the broader macro environment?
That's the thing. You never really know, right? When something comes out of the woodwork, comes out of the woodwork, right? You don't really anticipate seeing it coming. I mean, a bank failing, that's a pretty big one, right? But I mean, it's kind of like, I mean, 2009, right? The Lehman Brothers. I mean, they failed, but then the credit crisis wasn't for a couple of weeks later when it really hit. I don't know. I mean, so that's the thing. The Fed and Treasury may just get in front of everything, and they may fix some band-aids before it really becomes like a big issue. Or maybe there's a bigger issue lurking out there that nobody sees yet. That's the thing. And I think some of the stuff that's happened, maybe that's it, but maybe that's the canary in the coal mine, and it's impossible to really tell. I think but until the Fed starts lowering rates and you start to see some of this pressure, taking off the brakes in the economy, I don't know. You just proceed with caution, right? Because that's the thing. If you knew what it was, it would be easy to get around it and see it and fix it. That's the thing. I think what everybody's worried about the unknown, and what else is kind of lurking out there that they don't know about.
Yeah, that makes a lot of sense. So I know you also have the other side of your business is you have a JV equity and equity side of your business. I'm curious kind of what that looks like. Like who are the clients who you place equity for, or is it more of you source equity for clients that are looking for equity? And I guess what do JV equity I guess who's a good client for that side of your business?
Yeah, I mean, it's typically somebody who has like a track record of like similar size deals to like the stuff they're doing. And usually, each deal is like a minimum capitalization somewhere around 20 million bucks. And then you can get like a decent JV equity check in there. And the only stuff that we do is joint ventures, nothing that looks like a real estate security or anything like that, right? And our equity sources are typically like family offices and small to middle market kind of funds within investor capital, kind of raised around a strategy of deploying alongside sponsors. And so everything is like limited partner for the most part. A typical equity structure might look like, the limited partner comes with 90% of the equity, and the general partners come in with 10% of it, right? And then returns are heavily weighted towards the GP, right? Because then that makes sense to the operational partner. But yeah, I mean, usually a couple million bucks and up. And the areas where some people get tripped up is not having I would say like a track record of deals that they've done in the past, but maybe putting together like a decent deal up front. We have to look at it like, basically proving out that the strategy somebody is for, kind of projecting here has worked out for them in the past, and that their numbers worked out, right? So if like, here's your pitch, show me that you've done this a couple of times in the past before, we bring in some institutional joint venture partner. That's really what they're looking for.
Gotcha. Yeah, that makes a lot of sense. And I guess what are the level of return and the hold period that are typical? I guess probably case by case, but for example, you have family office, you say is a contender. What are they looking for on that side?
Yeah, I mean, it's probably higher in today's world, right? But it's, maybe like a 20 IRR at a 2x multiple minimum and like a 3 to 5 year timeline. A lot of this joint venture stuff is like shorter terms, it's like value add or construction stuff where you can recycle capital after 3 to 5 years. So if you look at it in like an IRR curve, like right when it starts kink downward, that's when they want to start to recycle capital, right? Because time is, the enemy of IRR, right?
Mm-hmm.
So once you've created that value and you've gotten to a point where you're kind of maximize your return in a certain time duration, that's when these groups want to like recycle and exit.
Yeah, gotcha. You mentioned bridge loans maybe before the show, but I guess there's been a lot of craziness with bridge loans originated maybe 1.5 to 2 years ago. You said that they're still pretty popular. I guess what has changed in that market? I'm sure LTVs are looking a little different and rates are obviously looking a little different, but are is interest rate caps, are they starting to come down? What are you seeing there?
Okay, so the bridge lending is what you're referring to is kind of what I described with like what is a great pref equity scenario right now.
Mhm.
There's a lot of that CLO debt that was originated at like super high, LTCs. Um, Bridge lending is still, yes, right. I mean, the big thing that's changed is underwriting, the exit assumption on underwritings, right? And that's the biggest part that's changed, right? Because the ones that got in trouble, they were underwritten exit caps at like 4.5 caps and exit rates in the fort, right? And we're just in a different world now. So that's the biggest difference. Yes, absolutely. Bridge lending is becoming more and more of a need. That's that private lending world that steps in when like banks pull back. So that definitely very important. Rate caps in today's world are basically, I mean, they're effectively priced at 100% of the rate movement, right? Because where the Fed is going and all this, it's been clearly telegraphed. Right. So it's hard to get somebody to take the other side of that when they clearly know that the rate hike is coming. So yeah, rate caps are super expensive. No, I haven't really seen. I mean, I don't know. I mean, they're coming out a little bit, but they're priced at about 100% of what their expected rate movement is. So I mean, yeah, that may. I mean, the thing is, cost of all this stuff, it's kind of determined on like a little bit of uncertainty. And so it's like the more clarity the Fed gives about when they're going to stop, the more spreads can come in. But they haven't really done that yet. Like, I mean, I think people have a good idea, but they haven't come out and really said like, hey, we're pausing for now. I think when that happens, you can see some of this stuff come in. Some of the costs of some of these rate caps, but until then, they're going to remain pretty expensive.
Yeah, I guess the intuition is that okay, rates have already come up a significant amount. Unless they're gonna double again, right? We're probably near to the top than the bottom. And if we're near to the top than the bottom, there might be an opportunity to cast a bet, right? Saying that maybe they pause after this next rate hike. That means we would not, or I guess we might not think we need an interest rate cap because we don't think interest rates are going up any further. Like there could be opportunities to like kind of make a bet here. And I guess what I'm kind of curious about is that just imprudent? Is that why no one's doing it?
Well, the lenders kind of require rate caps for a lot of these
Mhm.
deals. They just wouldn't get into them with that one. Um, but I don't know. Good question. I would just find a lender that would do a deal with that would just fix the interest rate,
Yeah, I
right?
mean, yeah, true.
They're out there, right? I mean, a lot of this, the guys who need rate caps are guys that don't really lend against their own balance sheet. And in this environment, what I would be looking for is somebody who's more of a balance sheet lender that doesn't require, purchase of a rate cap.
Mhm. Yeah, I guess that makes sense. And I guess yeah, if you want to get a little more granular with that, like what fundamentally is the difference between how banks look at deals and how private lenders look at deals? Like what allows private lenders to be more flexible now? I guess obviously there's less concerns with deposits and oversight and whatnot, but I kind of just want to just given that you talk to these people every day, I want to get a little deeper into what makes them different.
Um, sure. So I mean, like banks are regulated by the FDIC, right? I mean, that's the biggest difference. So yeah, I mean, they have very strict guidelines they're supposed to follow. And after the bank failures that are recent, there's more regulations coming in the pipe. They don't even know what they are yet. And they're subject to reviews and audits and all this stuff and risk tier ratings and all that. And banks typically underwrite on a global basis for borrowers. Private lenders, I mean, to a degree, really can do whatever they want, right? I mean, they're private investment funds, and their money is not depositor money; it's accredited investor or whatever it is, family office money or something, or maybe their own money, right? So I mean, realistically, yeah, they can do whatever they want. I mean, that's the biggest difference, right? I mean, one group is heavily scrutinized about lending investor or depositor money, and what they can do with it, and the other really isn't. So.
Hmm. Yeah, it makes a lot of sense. I guess from a efficiency, maybe this is getting political, but from your own personal perspective, is there do you think that the banking regulation and kind of the oversight is helpful or more of a hindrance to I guess liquidity and efficiency in markets? Like, do you think that I guess I just want to hear your thoughts on that.
Well, Silicon Valley Bank failing was a pretty big hindrance on liquidity and efficiency in markets. So I mean, they probably should have gotten some more oversight. It's hard to tell. It depends on who it is, right? Um, so I mean, well, like for instance, a lot of local regional banks, for their sizes, are probably overregulated. But they're usually pretty efficient, lenders. So I think it depends on which bank it is, and that's hard to say, right? Because there's some banks out there that still do pretty aggressive stuff.
Yeah, makes sense. Well, so you also have an insurance wing of your business. Can you tell me a little about how that started and kind of, I guess you want to be this full service provider for real estate owners, but yeah, how did you start that wing, and then kind of what are the issues that you might be experiencing there? I know there's a lot of talk about insurance rates going up, and I know especially in New Orleans, it's been pretty prohibitive in terms of being access to insurance. So I'm kind of curious how you're looking at that side of the business.
Yeah, look, anywhere that's coastal, right? That has like a wind issue, wind hail, anything like that that's subject to any sort of natural right disaster. I mean, the insurance has just gone through the roof, and that's one of the reasons why we started that side, right? I mean, one to be to service our commercial real estate borrowers, but also, I think my daughter's about to walk in here. Um, Also, because insurance costs are getting more and more difficult. You know what? She's standing right here, so let's put her up.
Hello.
Hi. So as that market, here, why don't we pause for a second? Let me give me a second. Yeah. So listen, insurance costs have gone absolutely through the roof, and that's one of the reasons we started that whole side.
Hmm. And I guess what are you seeing in terms of solutions on, I guess, how does starting an insurance company when costs go up a benefit to you? And I guess how are you able to, I guess, deal with this
Yeah. I
situation?
mean, like at the end of the day, I think the days of just auto renewing insurance are over, right? Because the incumbent guys, a lot of them are either just very hindered or they've just suffered a lot of losses. Because I think that whole insurance risk model was just not priced well for all the disasters we've had and everything moving forward, right? And so what we have been able to do since we focus 100% on just commercial property insurance is really have a lot of efficiency and focus just on that. Because like a lot of insurance companies out there or agents, excuse me, in general, do a lot of different stuff, right? I mean, they do life insurance and auto insurance and all this stuff, and a lot of people think that just because one agent has access to insurance, right? They think that that's just what it is, and there's a lot of opacity in that, opaqueness in that marketplace and how that whole thing works behind the scenes. But there's absolutely a degree of focus, and the fact that that's all we do really gives a lot of insight into the right places to go to and the right markets to go to.
Cool. So I guess, are you underwriting, or are you just kind of being a middleman for insurance
We're an agent.
products?
We're an insurance agency.
Gotcha. And so do you, just go, originate deals from whoever has the best terms at the time, or do you, shop every property around? I guess, how does it work on putting deals together on the insurance side?
Um, yeah, I mean, listen, we go to all the markets that we have. But to a degree, I mean, insurance companies are similar to how like the lending side is. Like certain ones, want, certain property types in certain areas, and kind of having those relationships and knowing who to go to definitely helps.
Gotcha. And so given that you have that insight, and you mentioned picking the right markets, which markets are favorable from an insurance perspective, that might help someone who's looking to start their real estate business to know which market to
I'm just
start
saying,
buying
if
deals
you're looking
in.
to stay away from high insurance costs, I wouldn't go anywhere where there's a beach nearby. Put it that way. So,
Yeah, that's fair. I guess maybe you have some insight into this. I thought, just give you, I guess it was Hurricane Ian in Florida last year. That obviously there's a lot of property, insurance claims. Um, from what I guess I went down some rabbit holes and I learned about cat bonds and all these other products, reinsurance backstopping the insurance there, and the risk obviously gets spread around a lot. I guess it seemed like it ended up being that Florida took a big hit. Florida taxpayers took a big hit on reinsuring those products. I'm curious about, just from your perspective, what aspects of the industry are changing, and guess like, what's facilitating insurance being a product in the future? I guess given that there's so much risk, like what's even allowing people to do insurance?
yeah. So in the insurance spectrum, right, there's something called reinsurance companies, and reinsurance companies are basically the insurance companies for insurance companies, right? And what happened was, because just natural disasters, as I'm not here to debate global warming, but I was in a debate that natural disasters are becoming more and more expensive, and the issue was that like that risk model was mispriced, and over the next few years and even going forward, right, that mispricing is going to be corrected. And realistically, it's just equating to higher insurance costs across the board, right? Because like what you need to do is you need to spread out insurance costs over a large portfolio of guys that are less risky and guys that are more risky, right? And so what that does is it's just a rising tide and it raises all ships, right? So even somebody's policy, for instance, that maybe isn't really subject to a lot of like wind damage stuff from the hurricane, they're still going to see increased costs, right? Because they have to offset the other guys that are for those
Hmm.
insurance carriers. So that's really where it's coming
That makes a lot of sense. So I guess you're getting a good deal on insurance and the beachfront properties.
I don't know.
Probably not.
I have some people like, with properties in Florida, they're like, just find me a deal where I don't have to get wind coverage because it's too expensive to even manage property without it. So,
Yeah,
or what that is.
yeah, that's pretty crazy. And then what happens when there's a wind event? But
I mean, yeah, I don't know. I've had some guys that are strong enough to handle on their own, and then I guess other ones are just praying. Yeah.
yeah, makes sense. Well, that's really interesting. I appreciate you walking us through all these different verticals of your business. It's super helpful.
Sure,
You ready for the lightning round?
sure, let's do it. Yes.
Okay, so you have a daughter, so you might be prepared for this one. But what superpower would you want if you could have any superpower?
Superpower, getting great sleep every night. How about that one?
Cool. I've heard not needing any sleep, but that works too.
I don't know. Sleeping feels good, man. So no, just getting great sleep every night. Let's
Sounds
do that.
good. That's a good one. So, what is your favorite book, or what's the one that's helped you the most?
Um, the Rich Dad Poor Dad books I really liked. Those gave me good perspective.
Awesome. So what motivates you to continue every day?
Well, my daughter, can't, and I have two others too. So, I would say family.
Awesome. And what advice would you give to someone who wants to follow in your footsteps?
Um, the number one thing I think that I did that helped me out the most was cold calling, and then not giving up when it was really difficult and it hadn't worked out yet. I think cold calling is one of the best skills you can have. And then if you're anybody who's ever going to start their own business can and successfully did it anyways will probably tell you like right when you feel like it's not working the most is usually when it's about to turn around. Basically because once you've hit the point where you've screwed up as much as you humanly possible, you learn from those mistakes and then you learn what works and then it starts to work out for you. So.
Yeah, that's pretty cool. I've heard that before, and yeah, I just imagine the amount of people who stop right on the precipice of success, and it's,
Well,
know.
you got to look at those F-ups as assets, right? It's like, all right, well, now I know not to do that anymore. So sure.
Awesome. So since I put you on the spot, I'm gonna give you a chance for revenge. So what's one question you have for me?
Okay, sure, man. What's your plan after school?
Yeah, plan is to find a mentor, or find a company where I can continue to explore my interest in real estate and develop further develop my skills. Just get that experience that I feel like I want as I and need as I grow in this industry. But yeah, so it's really I'm focused on finding the people who I could ask questions to and learn from, maybe learn from others' mistakes, which will eventually set me up to if not, start my own firm. Obviously, I'm going to be investing my own money, and so yeah, I just want to build up my skills and understanding of the industry, and obviously make some strong connections and meet the people who I'm going to do business with going forward.
Cool. Sounds like a plan. Good.
Yep. Well, I appreciate it. Thanks for coming on the show. Where can people find out more about your companies?
Our website, Clopton Capital, or hit me up on LinkedIn. I'm exceptionally easy to find.
Awesome. Well, appreciate you coming on. Any closing remarks for the audience?
No, I mean, if anybody has any questions or just wants to chat about deals and market, give me a shout. I'm always around.
Awesome. We'll encourage anyone to do that. Well, Jake and everyone listening, keep making milestones.
Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.
The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.